Let me just sort of offer up some amazing statistics, specifically in the private equity, right? And Mike mentioned about how the private equity space works is that in general now, obviously there's plenty of differences here, but company comes in, takes a company that's public and takes it now private, takes it away from the public marketplace, takes it private to clean it up and then eventually to spin it off in some way, shape, or form. This is happening more and more. So from 1988 to 2018, so for roughly about 30 years, the number of public companies fell 37%. So think about that. When you guys are looking for stocks to buy, or for any of our listeners are looking for stocks to buy, the number of people in the public market, the number of choices that you have has declined 37% over the past 30 years, close to 40 years now. At that same time, the number of private companies grew by 44%. Okay, so what does that all mean? Well, it all means that the private market space, private equity, that side of the marketplace, the marketplace that you maybe would have given thought to, is actually getting bigger and bigger and bigger over the past 30 to 40 years. Now, why is that? Well, there's many reasons, but one of the big reasons is the fact that back in the day, when companies needed to raise money, they would have to go to the public marketplaces. They would have to do what's called an IPO or initial purchase offering and sort of raise capital in the public markets. Well, because there's so much money now in the private marketplace, they don't need to go public anymore. And going public is good because you can raise some capital, but going public can be very difficult for startup companies or whatever that may be because it's heavily regulated. It's a very noisy place. Now, some would say it's a good thing, so we can sort of root out any bad actors there. But at the same point, going public, being a public company is a lot more stressful than being private. So that's why the idea that all these companies, there's less public companies out there, is because they don't need to go to the public marketplace anymore. They can shop and stay within the private. There's all this money here. So to go back to what we mentioned earlier, kind of like this, like leverage loans or thinking credit, just think credit cards, right? The ability to lend somebody credit to get them through or to start up their company or to build a new plant or whatever that may be. Well, in 1994, only 28% of the private credit or the credit marketplace was offered by non-banks or sort of these alternative investments. That has since grown to 75%. So 75% in the credit marketplace is now private as well. So again, it's just assets are moving in these two areas, whether it's private equity for stocks or that type of your equity in companies, or whether it's credit in regards to lending and loans and more debt instruments. These markets are growing, and that's the money that's being put into there is obviously growing as well. And that's really why, Mike, I wanted to have you on to the podcast, was because, look, our investors need to understand, our clients and investors in general, or general public, I should also add, needs to understand this a little bit better so that they know a little bit about how this universe works. Like, again, what questions to ask, if they're ever even considering it to even start, right? Mm-hmm. Not to mention, are they even qualified in the SEC's eyes? Like we were talking about accredited investors and qualified purchasers. I mean, there's so much here that, and again, it's growing, that I really wanted to begin this process, begin this journey of taking our listeners through this world because it's only getting bigger and bigger.